Have you ever wondered if the world economy as we know it is standing on the edge of a paradox? A system built on debt, growth, and jobs might be clashing with a future dominated by artificial intelligence and automation. For decades, governments borrowed to spend, companies borrowed to buy back their stock, and investors borrowed to buy assets. Debt rolled over seamlessly, interest rates stayed low, and populations grew steadily, making the system appear unstoppable. Low interest rates fueled leverage everywhere. Companies borrowed to amplify returns, investors borrowed to increase exposure, and governments borrowed to fund spending. Leverage became the invisible engine powering global growth. It worked as long as the world remained predictable and interest rates remained low. But predictability is fading. The post-World War II system, with the US at the center as the issuer of the global reserve currency, China as the factory of the world, Europe as the consumer, and Japan eventually as the lender, no longer feels stable. Trust in the dollar is slowly eroding. Trade and sanctions have become tools of power, and supply chains are being rewritten as countries form new alliances. Investors are questioning everything. What backs our money if there is no longer a rules-based global order? Gold, US treasuries, commodities, digital currencies? There is no clear answer, and this uncertainty has profound implications for markets. Japan played a crucial role in making debt work globally. Through yield curve control, it kept borrowing costs low by managing its 10-year government bonds, indirectly stabilizing global rates. But decades of low rates are ending. Yields in Japan are rising for the first time in decades, creating a dilemma. Defend the yen or keep debt cheap. They cannot do both. Rising yields in Japan ripple across global bond markets, influencing Germany, France, and the US, and introducing volatility into everything from equities to cryptocurrencies. Bitcoin exemplifies how modern financial systems have evolved. Originally a scarce on-chain asset, its price discovery was straightforward. Real buyers with real coins set the market. Today, Bitcoin has been absorbed into the traditional financial system through derivatives. Traders and institutions control exposure through futures, options, and synthetic products, which allow Wall Street to influence prices without touching the underlying asset. It's like a rare Pikachu card. The physical card exists, but hundreds of people can speculate on its value. Synthetic Bitcoin allows exposure beyond actual supply. The long-term lesson? Self-custody is essential. Holding Bitcoin yourself prevents manipulation and ensures true ownership. Markets are mirrors of our expectations for the future. When uncertainty rises,